Welcome to Capital Conversations, where innovation meets opportunity. Join hosts Karen Rands and Erik Nelson as they unpack the realities of raising capital, from angel investing to IPOs, and reveal what it takes for companies and investors to thrive in today's changing markets. Let's get started.
Welcome back. We are ready and we are live. It's so funny. For those who are just tuning in, like, we actually have a countdown. And for some reason, we always go like, are we really live? Yes, we really are live.
Yeah, I mean,
so this is the Erik and Karen show, Capital Conversations. We're back in our fifth time talking to you folks, but our fourth, what we call the official episodes, because we're doing them kind of on a monthly basis for those that are tuning in now. The whole purpose of this particular podcast or live stream is to share our expertise and inform you of the various methods for getting to liquidity in the company you are building or those private companies that you are investing in. Okay, so we have, and I'm going to go into a little bit more. That's whether you're a direct investor, an angel, VC, family office, or limited partner in a fund, and assuming that the manager partner knows this, right? Because, the best way to trust someone that is handling your money, whether it's your business finances or your personal investment capital, you need to know enough to know if they are doing something blatantly wrong or giving you bad advice because they themselves are not experts. Lawyers, accountants, even investment banking firms have specialties that they go deep in, and then the rest is sort of general knowledge. So we have, in this particular recap, so what we've done, we did our launch, then we did what is an IPO, the public and, the whole purpose and what all the different ways. It was very high level, but a lot of content. Then we did hot topics, where we went into examples of different companies that had recently gone public, what they did as part of that, what was going on in the general market, the impact of that on IPOs. Then we had a special guest interview. The new owner and operator of Moody Capital, Richard Krieger. Is that how you say his last name, Erik? You're muted.
Oh, sorry about that. I was making sure the phones didn't ring and interrupt us here in my office. It is Richard Krieger. It is a long E for Rich's last name.
Krieger, yeah. So that was a terrific episode of some, like, two guys that had known each other for a long time, just talking shop. So that was really good. I encourage you to go back and check that out. And then today we're going to talk about, this is where, like, the 4 weeks go, we go back into a deeper dive. So the guest might be the third week or it might be the fourth week. It just sort of depends on the availability of who we are targeting to have on the show and sort of that flow of things. But so today we're drilling down into IPOs and initial public offerings and IPO preparedness. And we're going to cover areas like legal matters, financial preparedness, business plans and market strategy, financial models, raising capital, all of that stuff, right? But I think it's important for you to, if you're new to listening to us, or you're new to knowing Erik or myself, let me just kind of the purpose of this is to equip our audience to know things that we have identified in our own conversations, our team calls. We go like, I can't believe people don't know this stuff. So that's what we're doing. And through the course of this, we'll go on a long and winding road on all matters about capital. We would just hit the IPO as the top of it because we thought it was a real attention grabber, quite frankly. So I bring to the table over 20 years experience engaging with private investors to understand their motivations for investing and helping entrepreneurs develop communication and capital strategies to engage those investors for raising capital or investing along the company life cycle as they scale to exit, because now there's so many ways that investors can be involved in early stage to late stage. And next month we're going to get into some of that when it comes to alternatives for traditional IPOs. And Erik, my friend, Erik Nelson brings 30 years experience working with companies. And, Erik, why don't you just explain it, because you know your history a lot better than I do.
Yeah, I mean, to keep it a little bit short this time, I started off out of college as a broker. I ran a small fund for a while, and as the consulting side of things took off, eventually over time we acquired a SEC registered stock transfer agency, Mountain Share Transfer, and we've grown and added services over the roughly 13, 14 years since we made the acquisition. And one of the things that I wanted to mention that Karen and I are working on doing is we're trying to give entrepreneurs and business owners a good state of idea of the capital markets today. And one of the things we want to do is we want to talk about and give you a good picture of where things are at today. So you kind of get the idea of what is going on in the capital markets. So if you're out there trying to raise money for your business, because it's a grow or die world, and I firmly believe after, the decades of doing this, that a company should always be prepared to raise capital and look to raise capital whenever possible. And we want to let you know how things are changing. We want to let you know what the alternatives are to some of the traditional capital raising methods like IPOs. The IPO market comes in and out of favor on a routine basis, on a regular basis. You'll have where everything is hot, and even poor companies have a hot IPOs, and then you got cold periods, or even the best of companies are struggling. And there's a lot of regulatory changes in the last 5 years, and knowing how to navigate those and how to take advantage of things, particularly the Reg A's offerings that we're going to talk about next week, which is where Karen's specialty is. It's important to know, because we also believe in there is a ladder to the capital raising process for startups. You do your self-funding, you do your friends and family round, and then you kind of work up the food chain to angel investors. That does open up avenues for crowdfunding, and then hopefully to an IPO or an alternative to getting public. And so by educating investors, what we really have is hopefully investors who know how to avoid the pitfalls that cause a lot of great businesses to, never live up to their potential. So, what we're going to talk about today is IPO preparedness.
And at some point, one of the big ways to create liquidity and get to an exit and, get a return on your investment, or as an entrepreneur, return on all your blood, sweat, and tears that you put into building that business, is also through merger acquisitions. More companies actually exit through an acquisition than through IPOs. And so at some point, we will be covering that as well. We will be covering, really everything there is to do about capital, right? So, but first, before we get into giving you all of our golden nuggets, I have to read the disclaimer. This information is provided in this podcast is for educational and informational purposes only and is not intended as financial advice. The views and opinions expressed by the hosts and guests are their own and do not necessarily reflect the official policy or position of any financial institution or organization. You should always consult with a qualified financial advisor or conduct your own research before making any investment decisions. The content of this podcast may include forward-looking statements that are subject to risks and uncertainties. We do not guarantee the accuracy, completeness, or usefulness of any information discussed. Wow.
That's a mouthful.
Yeah, no, but that's like, we don't guarantee anything. Y'all, we're just like, whatever, right? By listening to this podcast, you agree not to hold the hosts, guests, or any affiliated parties liable for any losses or damages that may arise from your reliance on the information provided. That sounds like that sounds very much, I know it's part of our discussion where when you're doing forward-looking statements, right? But there's always a thing when it comes to public markets on what can you say publicly that might influence your current investors or your future investors as a public company. So I'm sure we're going to get into that. But reading that statement made me think about all of these little caveats that companies have to put on to their pitch decks and documents. So anyway.
Yeah, and I'd like to mention, if we ever do mention Any small companies in our podcast, we will have a disclaimer at the end of the episode to let you know whether we actually own shares in them or not. And the
Oh,
last
that's
thing
a
in the
good
world
point.
we want is for someone to buy something that we own and then we sell later without it having to be disclosed. So we do our absolute best to be as truthful and transparent as humanly possible, and double check to make sure that if we own it, we let you know, and if we don't own it, we let you know as well. So
Very good. See, that's we got to everything above board to our best capabilities. Right. So, with that, okay, Erik, what is IPO preparedness?
so IPO preparedness is a term that has come into vogue the last couple of years, but basically it is the steps you need to go through to prepare your company for a potential IPO. And one of the reasons why we're talking about this today is by doing so, you will make your company much more attractive to investment bankers and make them much more receptive into looking at your company for an IPO or a private placement. And this is really preparing for an IPO is demonstrating that you're getting ready and taking the steps to be part of the big leagues. When I was younger and in college, the pinnacle of success for a lot of entrepreneurs was to get their company public. I was successful. I started a company and took it public, and that's not what it used to mean due to some regulatory, a lot of heavy-handed regulation. But it's still a pinnacle of success to get your company public, and to grow your company, make it successful, you eventually are going to probably need to work with investment bankers. And this is what this episode's about. How do you demonstrate to them that, if they give you money, that their investors will be able to get it back? So that's what we're going to look at.
Okay, great. And so, why is that? I mean, is it significant for people because it costs less? They can get more value when they actually get their strike price if they get the interest of the marketplace. Is it more, what I know we're going to dig into the key components, but what is the return on the effort of money for a entrepreneur, a founder, and their board to make sure that they're IPO prepared?
The way things work a lot nowadays is you get in front of investment bankers one of three ways. You randomly dial broker dealers and you send them packages on your firm. You get a referral, or somebody like myself would help a company prepare a package and show it to the investment bankers we know, or you go to a conference. There's several out there, but you go to a conference and you present to a room full of investment bankers and you hope somebody likes what they see. And I attend a lot of these conferences, and what happens is you go talk to a company and you go, well, where are you at on the process? And they're going to ask you some of these questions. And if they say, well, do you have audited financial statements? And you go, no. And they start asking some of these other questions and it's no. Well, they're probably going to move along. Do you have securities counsel retained? No. Well, it becomes a lot tougher. But if you can demonstrate that you are prepared, that you have the information they want to see and it's readily available, then they're going to take you seriously. It doesn't guarantee success, but they're going to say, somebody has deal experience and is part of this team. This is a company to look at. And
Yeah.
so this is the key significance to it.
Okay, I'm going to come back to that because I want to get through these elements, but because I want to come back to talking about, the beauty contest of getting picked up and how much of it is that we're not going to talk about right now, the structure and preparedness versus market cap, because I want to get into like the challenges that unicorns are having and why it is having a negative impact on the markets because the way venture capital sort of drives a lot of that. So we're going to come back to that. So put a pin in that.
Okay.
Right now we're going to talk about the key components of IPO preparedness, legal. So the first thing, and this is something that kind of comes up all the time, and I'm going to kind of wrap this all up into a question so that you can hit all the key pieces of this, right? So, corporate structure. The traditional way, as I've always seen it, is, you got common stock is what people buy when they're buying, selling stock on the public market. But when you're raising capital, you usually want to have preferred and common because angels and VCs like preferred, and then those convert into common at the time that you're getting ready to do the IPO. But and LLCs typically are when you don't have, for tax purposes, they're doing pass through, but when you start to have a lot of income, you don't want to have it pass through in the same way. So you switch to a C Corp, but there are companies that have gone public as an LLC. So talk about the pros and cons of the different corporate structures and those considerations, so people where they are from startup or growth, and how important is it to be a C Corp versus an LLC, and then we'll get into some of the other elements.
Yeah, I mean, what we end up seeing is a lot of entrepreneurs, for tax purposes, have structured their corporations or their companies as LLCs. And occasionally we see a few limited partnerships. And the primary driving factor for those is pretty much the tax structure. But once you're going to become publicly traded, the advantage, those advantages go away. And so everybody kind of converts to a corporation, because effectively, as an old friend of mine used to say, don't try and sell apples to a guy looking to buy oranges. You want, and what he would mean by that is you want the structure that's most receptive, and the public understands corporations. And those select entities that trade out there as an LLC or a limited partnership are primarily doing so because they're in an industry such as oil and gas, or they're in REITs where they have certain tax advantages for that.
Okay.
The one drawback to those, and I have in my personal portfolio a bunch of oil and gas royalty trusts. The one drawback is they are difficult on the accounting side for tax purposes. So when you go to file your income taxes every year, your accountant just is like, oh my God, these are extra work. I hate them, So you want to be out there in a uniform structure such as a corporation. And then you want your share count to be at a number that provides a meaningful per share numbers for analysis work.
Yeah.
So
yeah, I want to like hit that, because one of the things that I think a lot of entrepreneurs, it's getting started right is a big part. And I, it seems like I get called in to fix a lot of things a lot of times, particularly on capital strategy and their messaging to investors when they're struggling to raise capital. But one of the things, and I was having a conversation yesterday with somebody about this, asking how many shares did she set up, and she had gone through an incubator and had a cap table, but she had like 3 different valuations already, and she hasn't even gotten to revenue. You know what I mean? So like of what she had done on her safe note. So I warned her about that, because it could end up being where you have to do 4 times the amount of cap of shares than what you expected for that one, because the valuation was so low, and then when you get the institutional round, it's higher. How many shares do you have? If you go to the Secretary of State, in your state might say 100,000. If you go to one of those online incorporation things, they're going to be like 100,000 shares. But here's where it gets really, and this is part of what the point that Erik was making, is that like Microsoft went public with hundreds of millions of shares. And the reason why is that and so hit this, Erik, the difference between issued and authorized. So each round you're issuing more shares, and the pool of shares gets larger, but the stock price for each share goes up. as you go through that. And you don't want to start with a stock price of $20 a share just because you have too little shares, so that by the time you get ready to go public, you've got to do all kinds of splits and all this stuff to get an ample amount of stocks so that your strike price on the public side can be like $20 a share, right? You know what I mean? You want to start like $1 a share, have enough so that as you grow in value, you get to a point that is logical for the people. This is the apples and oranges thing. It's logical for the people that are buying your stock to go, oh, that makes sense. They're a $20 a share stock. They're not $100 a share stock at the initial strike price because they started at 20, right? So add on to that.
Yeah, and if your business earns, $1 million a year and you have 10 million shares, you have 10 cents a share in earnings. But if you have $1 million a year in income, you don't want to have 100 million shares and only have 1 penny in earnings. Because your analysts are going to look at that and go, well, we think this company's worth 30 times earnings, and you either got a 30-cent stock or a $3 stock. And there's a lot of rules and regs, such as the Penny Stock Act of 1990, that come into play that impact, the ability of investors to purchase those shares. So determining proper corporate structure, and meeting the exchange listing requirements and having something that makes you look like you fit in with your peers and your comparable companies once you become publicly traded is important. And that's the role of, a lot of times investment bankers and outside consultants such as us, is to help identify those comparables and help you develop that structure so you can come out at a decent valuation and raise capital at an attractive price per share.
Yeah.
So that is one of the key things about, going through a review and looking at your structure and seeing how you compare to other companies in the same industry.
Yeah. If your destination is an IPO, if you think that's what it's going to be, even if it's an acquisition, it's really important to make sure you got a full tank of gas when you get going so you can get to your destination. So starting right. So think about when you're and even early on, because there's a lot that can be adjusted in your seed round with that then later, then it much more costly later on if you try to fix it when you have lots and lots of shareholders. So let's talk about prior stock issuances, because, you mentioned that that they've done proper issuance exemption. What is a proper issuance exemption? Because one of the things that I've heard about and all this kind of stuff is like, there becomes a dark period where in some cases, we talked about this on the first show, I think, that we did, where there are some cases where you have secondary exchanges and employees are selling stocks they've owned for 2+ years into the secondary market before the IPO, right? Or under a Reg A Plus before the paperwork is completed. And you have that part of it, but then there's this dark period, and sometimes people get stuck and an initial strike price drops because their market cap doesn't support it. It was all hype and not substance. But people are locked up and can't sell their stock, so they lose the value. So is that part of the prior stock issuances and issuance exemption, that dark period or not period, or whether you can sell them ahead of time?
A little bit, but primarily what we're looking at is when you've raised capital in the past, have you done so in compliance with the proper rules and regulations? So back almost 100 years ago, prior to the Congress passing the Securities Act of 1933, there were virtually no rules on selling shares to investors. And Congress got together and passed the Securities Act of 33 and the Exchange Act of 34. And the states got together and they started enacting a variety of laws, restricting who you can sell shares to. And a good way to think about it is effectively all unregistered sales of stock are prohibited unless you have an exemption. And then they go out and they create all these exemptions. So obviously, if you're the founder of a company and you're not soliciting the public, there's a blanket exemption. And when you start to
And those are the Reg D offerings, right? Just to make sure the exemptions are the Reg D. Traditionally, it was 506 and 504 that have all been modified as a result of the Jobs Act. But the exemptions are the Reg D offerings.
Well, so effectively, the state of Georgia, where we're at, has a state exemption. If I form a company and you and I are going to run it, we can write the checks, and we're the officers and directors and founders, so we're good to go. If we want to bring in, say, for example, my sister as an investor, then the Securities Act of 33 provides an exemption technically known as 4A2, and the state of Georgia gives you an exemption for up to like 15 investors. But then you start to cross state lines, and you can rely on that exemption sometimes, but then you have to have an exemption typically pursuant to Reg D and do your 506 or 503. And a lot of times what we see is everybody relies on the standard 4A2 exemption when it's not really available. And then you got to go back and you got to correct that. Or one of the biggest problems is a company pays an outside finder who's not registered, and then there's a right of not a right of redemption, pardon me, but basically investors have a right to put their stock back to the company and get their money back if it's not done properly. So what we're really talking about is, have all the share issuances that have been, authorized and approved by the company, have they all been done properly? And that is a big one that gets a lot of companies in trouble, and sometimes makes it so they're not actually able to go public themselves.
Okay, so I just trying to look up 402A exemption. I guess I need to do it because it's only bringing up tax laws on that.
No, it's technically it's a 4A2 exemption of the securities. 4A2 of the Securities Act of 1933. And that's an actual section, so it's not a rule or regulation. But for those who are asking,
so that's basically establishing the ability to do the private placement exemption that falls underneath all of those, the Reg D, that section. And 504, but in Georgia, with Invest Georgia exemption, as with many other states that have elected for interstate exemption, it's under the 504 exclusion or exception or whatever for Reg D offerings, right? Because the 504 used to be the one that would allow you 15 unaccredited for like family and friends and stock, and your programmer and stuff like that to have shares. And then they made that be the blanket cover for states to be able to do intrastate so that they didn't violate federal laws.
That's correct. And
Yay!
And just for the record, anybody who wants to look up some of these, the University of Cincinnati maintains online the Security Lawyer's Desk Book.
Yeah.
And if you Google Security Lawyer's Desk Book, that is for most people, the number one reference for all the securities rules and regulations that the U.S. government has put into place. It doesn't deal with the state ones, but on the federal level, that's the best. And I'll have a link to that in our show notes later when we get those posted.
Okay, great. All right. So we were talking about the prior stock issuances and making sure. So it's a securities attorney then that would look at it and make sure that whatever you filed. So like even, for example, if a company did something under crowdfunding, there's actual, particularly Reg CF, there's an actual form. People got kind of sloppy there for a while when the Jobs Act first came out and be like, I'm crowdfunding. And they actually didn't file anything or do anything properly to say they were crowdfunding. They were just general soliciting without the right to general solicit. Because I remember back when it first was announced and the rules weren't out. And I'd go to the conference, they'd go, oh, I'm crowdfunding. I'm like, how can you be crowdfunding? The rules aren't even out yet to be crowdfunding, So the takeaway from this, Erik, is to make sure you've got a good securities attorney that can look at your prior history and make sure whatever files. And is there always a recourse where you can go in and file an update without a penalty if you correct it before you actually do a public filing?
Yeah. So there's almost always a corrective filing or a ratification type filing. So you can, for example, say, we didn't file the Form D, and so we're going to retroactively state that this was a offering pursuant to Reg D because we met the qualifications.
Yeah.
So, but this is a must-have item before you can ever get listed on an exchange, is because your security counsel has to attest to the exchange that all the stock issued by the company has been issued properly.
Yeah.
So that they protect the integrity of the exchange.
And a rule, let's just to make sure, like a good rule of thumb for those that are listening, your IP attorney, your general counsel for corporate business matters for contract law is not your ideal securities attorney, correct?
That's correct.
Okay.
So your attorney who's, really good at your lease and all these other things, and maybe some HR stuff, your general counsel does not have the specialty, the specialized knowledge to get you through an IPO. Okay. And, when you get into the field of securities attorneys, not all securities attorneys are created equal. And your guy may be the number one guy for hedge funds in the country, but he may not have worked on any direct IPOs in a very long time. Yeah. And you need, and things change a lot. And it's not that really bright guys can't learn, but sometimes you got to go with the expert and give her a call. Yeah. So,
and people, because we have a network. So if people come to us with questions or they reach out and direct message you, you're going to be able to have a conversation with them and talk about some of those issues and make some recommendations, right?
Oh, yeah. I mean, through our activities at the transfer agent and the conferences we go to, we are in communication with attorneys across the country. I mean, from Washington to Florida and from New York to Southern California. We've spoken with hundreds of attorneys over the years, and we have some very good attorneys, each of them highly specialized, that we can recommend to those in need.
Okay. And in fact, we're going to plug it here at the end for next month, but you're going to a conference. We're going to do a live stream from that the last week in April, and you're going to be, rubbing elbows with all the people that know, what's the name of that conference, that know all about this, public offering stuff.
So we're going to be on the week of April 22nd at the Planet Microcap Conference. It's at the Paris Hotel in Las Vegas. It is, I believe, the largest microcap conference in the country right now, with, I believe, almost 125 companies are going to be presenting this year.
Wow.
And investment, some of the top investment bankers in this field.
And now microcap, just because then we got to get through our agenda here. Microcap, for people that are already public companies that are trying to create more interest, or is it just the size of the company that they fall into microcap and they're going to be in the public market as a small company growing? Give a definition on that.
Microcap companies are those that are generally considered to have between 50 and 250 million in market cap. So when you go to a microcap conference, what you're looking at is a majority of these companies are revenue producing companies. A high number of them are profitable, and they come from a variety of industries, really across the board. I know that one of the companies there is going to be a pretty sizable company that is in the oil and gas services space. So they basically do oil field services. And then you'll see high-tech startups, you'll see biotech, you'll see Bitcoin companies. I haven't looked at this year's list. I did, but I recognize some of the names from, the Vancouver conference in the fall. And, it's companies from all across our economy, and that's what makes this great, because these are the companies that grow and create the jobs and get big.
Yeah.
I mean,
Microcap Conference is not a sponsor, even though that sounded like a sponsor or advertisement for Microcap Conference. But we're going to now get into financial preparedness, right? So
yep,
this is, you know, it's real. You know, you talked about it at the beginning. If you're going up to an investment banker, you're going up to brokers, like at this event, there'll be a lot of companies that will be going up trying to market them, to pick up people to represent them as they go public. So let's blend it together, talking about because this is something that I became aware of, that not all accountants are created equal, and that there's even a special designation to be able to do books for a public company, and even to be able to do the audited. There's a special kind of audit. So there's the regular audit. So the categories are like review. There's been a review. There's been a review with comments. Then there's been an audit, right? And then
yep,
there's an SEC audit, which is like an even bigger, more detailed thing. And not all auditors are capable or licensed to do the SEC version of an audit, right? So talk
correct.
about that, and finding and figuring that out, and the impact that once you find a security enabled auditor, hopefully it's in the same firm, so somebody, because they cost a lot more money. So you've got a regular accountant, and then you grow into this other one that may just do they do it just at one time, and does it make a difference between accrual and cash basis when they get ready to do those kind of level of audits?
Yeah, when your financial statements are going to be included in your SEC filings, which is mandatory in order to file with the SEC, you have to have them audited by a company that's registered with the Public Company Accounting Oversight Board, the
There you
PCAOB.
go.
And they look to hold auditors to the highest of standards. And effectively, in today's world, the only auditors that can have their financial statements they've audited included in filings are PCAOB registered auditors, and they publish an audit opinion letter in those financial statements. When you get to this level, your accounting is going to be done on an accrual basis. Do you record your liabilities when you get the bill in the mail, and do you record the payment when it's actually made? It's things like that, and as opposed to the proverbial running it out of a cigar box, as they used to say, where it's just kind of cash in, cash out. But where companies get caught up in this is they have a bookkeeper who's not up to standards. And so a lot of times this is what we'll see is we'll bring in an outside accountant who's got public company experience that'll help the company get its financial statements so they can be audited. And as that grows, what a company will do is they'll either hire a CFO with public company experience, or while they're looking to grow or get the capital to do so, they retain an accounting firm that'll help them prepare the books and get them so the auditor can do it. So you actually have a bookkeeping accounting service that knows what they're doing in preparing those for an auditor, who then comes in and audits them to ensure their accuracy. But that is an important thing. But if you've got bad records, there can be months and months of cleanup work to reconstruct things so they can be audited.
And that every month and months is $sign, 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 $sign.
Yeah, because while you're spending time, burning time doing this, it's you're delaying your access to new capital. And so it's important to get those things in place and have proper record keeping, so that if you do have to go back and make adjustments, they can be made.
Well, and also that high dollar, high value expertise. If you pay for them to do the work in 1 month because you were ready and you've done an audit, so you've got it, they just have to review it, is a lot different than if you have to take 90, 120 days to actually get your books all put together properly, because now that's 4 times of that highly specialized, expensive skill.
Yeah, or importantly, if you get comments from the SEC where you file a registration statement or file your financials and they come back with questions, it's called getting comments. You have to answer them, and you have to answer them to the SEC's satisfaction. And if you do not have a good team with you, that can be a time-consuming process, or it can be a never-ending process. And
yeah,
thankfully, we have good experts in that area.
Yeah. Okay, so one of the things, and you had on here business plan, and so my question to you is, what is the purpose of a business plan when you're going public? Because when a company is, newly offered an initial public offering, I don't know any stock purchaser that reads a business plan. They look at some analysis work. So is it for all the analysts to be able to make an opinion that then the public says, yeah, this is worth buying at $20 a share because an analyst looked at the business plan? Or is it just to market to those investment bankers and those broker dealers that you're trying to get to be advocates for your company and go out there and create a market for it? What is the purpose of a business plan, and knowing I understand for market comps, is it just internal? Tell me how people use that, companies use that when they're going public.
Well, that's an excellent question. You commented about, the financial offering documents. When you're working on SEC filings, an annual report or a registration statement, which is very similar, they have a business plan section, but that is not actually a business plan. What we're talking about here is you internally develop a business plan that kind of serves as a guide for your business. And that business plan, ideally gets shown to your investment bankers, and they're going to page through it. And they're going to say, do the assumptions in here make sense? Do these guys have a track record? Do they know what they're doing? And that's going to be something that's really kind of be, the business plan is going to be between internal management and the investment bankers. Back when I was in college, I was part of an entrepreneurship program, and one semester my mentor was the head of the largest venture capital firm in the state at the time. And he said on every business plan he gets, the first thing he does is look at the resume section. Do the founders know what they're doing and have a track record? But in today's world, if you think about it, the investment banks have, they've got the investors. They want to know if you're going to be a good steward of their investors' money, and that's what that business plan is going to show them. And that's also why you need a good financial model as well.
So now, is that the same as a prospectus, or is that different than a prospectus?
It's different than a prospectus. A prospectus is a document that is geared for the investors and the analyst, and that contains the necessary disclosures and risk disclosures for them to, hopefully evaluate the business. The business plan is internal.
Okay, so a business plan is to a prospectus the way a business plan is to a private placement memorandum, a PPO.
Correct. Yeah, it's a very good
One's
analogy.
Private, one's public. Okay, so when you say competitors, is that from an internal standpoint? So if there's other big, juggernauts within the same industry that are going public at the same time. So you're taking the breath out. There might be take the breath out of the room for that sector, or is it just is it so it's specific for can you compete for the same investor dollars when you go public versus, your traditional competitors that you're in the marketplace competing against?
Whenever you're running a business, you want to know who your competitors are within your industry. And so, for example, if you're a specialty retailer and you're servicing the golf industry, you want to know who else is a major retailer of golf equipment out there and golf clothing. And then if you're saying, well, hey, I'm a great retailer of golf equipment. I want to go public, and I think my valuation is X. The bankers are going to look at, other specialty retailers that are publicly traded, or people that retail. So, for example, they may say, well, we can't find another golf retailer, another company that's exclusively, selling golf equipment. So we're going to look at a large sporting goods store and some of these other specialty retailers and try and develop comparables to identify your valuation.
Well,
But
now
also,
I thought you said, so how is market cap different from valuation? Because it was a dollar, like it was a price for all of your shares based on your revenue, but it sounds like it's something different.
market cap and valuation are substantially similar terms, but they're almost interchangeable. The term market cap is generally used once you're public, and your valuation is kind of used while you're still private. But we're talking about enterprise value. That kind of includes valuation. Enterprise value being the value of your shares plus the debt.
Yeah.
But they're pretty much interchangeable terms.
Okay, so in the 10 minutes or so we have left, you just opened up the doorway to what I wanted to bring up, which is unicorns. And,
Yep.
That is a big thing. We didn't really get into it when we did our hot topic, and we don't have time to get into it now, but a lot of some of the big major VCs are buying back shares from private shareholders in these unicorns to give them more time to be patient for the market to be ready, or for them to build their business model up to create an actual market value that is, or a market, what they could be compared to what their valuation is. Because what most people don't understand about unicorns, and if you're not actually familiar, I'm certain you're familiar with the term, you've listened to this podcast, but the whole unicorn name evolved because some VC person said, oh, I'll never see a private company with a market cap or a valuation of $1 billion until they did. That would be like seeing a unicorn. Well,
Yep.
now there's like 300 some odd private unicorns out there. And it's because, spoiler alert, it's because so many VCs and private equity funds have put such huge amounts of money into it that gets added to the valuation, and oftentimes has nothing to do with the actual business model or the revenue or their true market potential of how much revenue they can make within within the foreseeable future. They may get there in 20 years, and so when they go public, you've seen some real, very famous flameouts because they went public at some strike price that should warrant their value, but they didn't have, Snapchat being the one that most readily comes to mind, because they didn't have a value and a revenue model to support it. Their value is just based on the money that was put into it. So, so within that context, can they make it up with their, forward? Because you're not allowed to do, when you get into financial models, you're talking about modern financial model. Is the modern financial model to create vapor companies that are unicorns and really don't have the value?
No, I mean, when you're taking a look at
That's
these
a
things,
rhetorical question.
no, but I mean, when you look at some of these things, these unicorns, you know, they get their valuation because of follow-up funding rounds, second, third, fourth, fifth, sixth funding rounds. And, their financials are private because they're not public companies. And, these guys look at things and they see things that from a different perspective than maybe you and I. I mean, these are, super big venture capital firms participating. I believe public markets are the true judge of value. Active trading, get out there, trade more than 1 million shares a day on a listed exchange, and we'll see what you're really worth. Sometimes the market gets it wrong, sometimes it gets it right. Um, but buying back stock as a venture capital firm, to me, is a very risky proposition. because you're really betting that it's going to go public at a lot higher than what you paid for it on that buyback. And you also got to understand that, that buyback's probably also a lot more expensive than your initial price that you paid. And if I was running a VC fund, I wouldn't be buying anything back. I would be, I got to be a seller to return capital to my investors and get my carried interest.
Yeah.
That's, and I'm kind of surprised that some of these funds actually are allowed to do that in their charter. But
we'll have to revisit that when we get into hot topics. So, we're talking about, on the financial sides, and a private company most often will show, like, if I get this money, this is what I'm going to do. This is my best case scenario, my most likely, my worst case scenario. But, to me, that sounds like a forecast. But are forecasts allowed in an IPO? I thought there was like a whole lot of rules around forward-looking statements.
So you're not allowed to make certain forward-looking statements like big forecasts in your IPO documents. You can talk to your investment bankers about things, but the financial model, with Excel and everything else, should be, one that dynamically updates. So if you start changing your assumptions, the entire spreadsheet updates. But really, this is where, the analyst for the investment bank comes in and picks apart your financial model and says, these guys are full of it, or I think these guys are onto something. They appear to be pretty smart. So a good, and I've been in the room for those conversations. They will try and attempt to poke holes in your financial model everywhere possible. And if you've got a good one and your assumptions are valid, you've got traction and you're on your way to getting an IPO done.
Okay, what else do you need from a corporate governance standpoint? You've got, a board of directors. Does it matter who is on the board of directors? Does that influence the market value, or does it just make it seem more better, less risky investment for taking a company public because they actually have good governance from their board?
So all the exchanges have adopted corporate governance standards. And one of the most common one is that the board must be majority independent members, non-officers, non-officers, and that you have to have an audit committee. And that means you need people that are financially qualified to, review and judge your financial statements. And typically that means you're going to need a couple of CPAs, preferably CPAs with public company experience. And that can either be from an auditor or a former CFO. But I can tell you that from personal experience, when it comes down to it, if you start to have an issue with the SEC, or you start to have, your auditor ask questions, the composition of that audit committee is invaluable. People who don't have the proper experience aren't going to answer questions properly. People with the proper experience are going to be able to answer the questions in such a manner that demonstrates that you guys have done everything right. You got to have the experience there. And then you also have to adopt codes of conduct and other items such as that.
Okay, great. So now we talked about this, I think, when we did the initial one at the beginning of this month on the overview of IPOs and public markets. Do the different exchanges have different requirements, NASDAQ versus New York Stock Exchange and so on and so forth?
Yes, they do. They all, the exchanges are kind of segregated into tiers. You have a smaller company tier, which is the NASDAQ Capital Markets and the NYSE Venture Amex. And then you have their main tiers which is NASDAQ National Market System and the traditional New York Stock Exchange. So Microsoft and Google are national market system companies. Other smaller companies, like a lot of startup biotechs, are going to be small cap, NASDAQ small cap. And so as your company becomes larger and you upgrade to a higher tier, your governance standards get tougher because they figure you have the resources to comply with them. And then at the lower tier, the different exchanges, they have slightly differing requirements. And that's a little bit how they compete amongst themselves. we'll make it easier over here, but it's going to be a little harder on this one. So we're generally viewed as being in compliance with the SEC's requirements. And then if somebody comes out with a bad idea, everybody rushes to apply to the other exchange until they correct it, and vice versa. So
yeah. Okay.
and that happens.
We've covered a lot of ground, and we talked about some of the legal issues and the financial pitfalls. Making sure you have the right financial document statement. All of your financial statements are clean and above board. You're completely transparent. Is there anything operationally that a company needs to be prepared for going public? Because we talked about the business plan from an internal standpoint, but it seems like operationally there might be more, because they may raise capital as this that scales, but then there's also, does all of the operational stuff have to get reported once you're public, or is it really, because there's key performance indicators, those things aren't as important as it is for just your financials when you're reporting afterwards? Like, talk about what operationally is required as we wrap up.
Well, it comes down to a lot of internal controls and procedures. As a company starts to prepare to be public, and once it is public, you've got a quarterly reporting obligation as a public company, and 4 quarters, three quarterly reports and an annual. Do you have the personnel to keep your records in such a manner that you can meet those reporting obligations? Do you have a comptroller who does the accounting and a CFO that does the oversight and the forecasting? Do you have the committees? Do you have the compensation committees? Are you holding board meetings on a regular basis? Are you keeping proper records of that? That is I think the most important thing. And then the CEOs, a lot of what they do is they travel and they present at conferences and to investors to make sure that there's adequate interest in the stock. And then they help,
So you have to be able to run the company without you being there. That's an operational requirement.
You've got to have somebody who can do things in your absence. And they want to know, for example, if the CEO dies, what's going to happen? They don't want the company to die because the CEO had a heart attack. And that actually happened a couple of years ago with one of my clients. The CEO passed away suddenly without warning. We had to recruit new management. And
Wow.
that occurred because of the board. We had a good quality board that was able to come in and have the right connections to bring in an almost ideal CEO for that set of circumstances.
Yeah. And then I think as the financial metrics, we touched on this, but so knowing that internally, so you don't implode on it, that, you can sustain it. And I think I just saw 23andMe. They were one of the golden-haired IPOs a couple of years back, right? And they're now filing bankruptcy. So, you have to be able to know that you have a sustaining business model and that you've got a growth strategy. That's where, not just the hype of a company that everybody knows and is a unicorn, but, can you sustain? And then part of that are the financial metrics show that kind of stuff to highlight pre-IPO. So it's not just revenue growth, but it's also being able to show your profitability margins, your cash flow stability, and your forecast that you are a well-functioning, profitable, growing company. And, you're raising capital as you do this IPO, and it's for all these great things. So more people want to buy your stock because you drive the after public offering stock price. It goes up because you are communicating that you're doing these things that are growing your company, and therefore your stock price should go up and more people want to buy it.
That's very true. And another thing that I think is important is be able to craft this into a good investment narrative so that when you do meet with investors, you can tell them a proper story. And I know, Karen, that for the companies I've seen present over the years, you're one of the best at coaching companies on this strategy. Would you like to offer a few comments on what goes into a good investor presentation?
Well, thank you, Erik. I would say that it is really important to be able to be very clear on the problem that you're solving and why your target customer specifically wants your solution. So it's all validated. Now you should figure that out, as you have to do that as you're raising private capital and it's not as much known. But, a lot of times entrepreneurs, companies get flat. They've got this idea that they're going to grow and get to this point where it's a logical exit of an IPO or an acquisition. And instead what happens is they go flat because they don't understand their true customer relationship. Who's going to buy it, how often they're going to buy it, what's the sales cycle like. So they don't raise enough capital in the private stages to continue to fuel their growth if they're going to be something more than a lifestyle business that then gets to some kind of an exit. And so it's really important to be clear on that. That's where the business plan becomes a narrative of your financial statements, your financial, where you are, where you're going. You're bringing out a new product, you're adding a new revenue stream. How are you growing that revenue stream? And the business plan is the narrative of that. And the presentation is the visualization of that in pictures, not as many words. And it's like, why are you doing this? Why you're the best at it, why customers want your product the best, why you're better than the competition, how you're going to continue to grow the product line and grow your revenue stream with upsell, cross-sell, and as well as adding more customers into your database. And that needs to be done very quickly, succinctly, because, the road shows, the dog and pony shows that Erik was talking about, you will do those before, during, and after you go public. And so on that, you should also, it's worth investing in somebody that can teach you. If you're not comfortable speaking in public, then it's somebody to coach you on speaking in public and delivering that presentation, because it makes all the difference. You think about the companies that and their CEOs. Those CEOs are dynamic. And I can tell you this, Bill Gates, when he was first starting out, was not a dynamic guy. He's barely dynamic now. And, but he
Barely
has
is
been
now.
coached. He has been coached, and to be that, if he was going to retain being the face of the company, he had to learn how to be very, very comfortable in front of people. Zuckerberg's still working on it,
Yeah.
But so with that, we are 5 minutes over our scheduled time of what we try to keep people's attention at. I want to encourage everybody to make sure they book it every Tuesday, 11th Eastern Standard Time, and come back and watch the prior episodes. They currently are only available on LinkedIn. We will let you know when they're available elsewhere, but they're all here on Erik's wall. And next week, we're going to dive into alternatives to your traditional IPO process and start covering some of the things that we hit at the high level in the first go round. So thank you very much for tuning in. Erik, any final comments?
No, I will be, like I said, at Planet Microcap. My firm, consulting firm, Coral Capital Advisors, is one of the sponsors of the conference. So if you are attending, the Planet Microcap conference, please stop by our booth and say hi. In the meantime, if you have any questions about the services that are offered by the firm, it's coralcapital.com, www.coralcapital.com, and we'll be happy to talk to you about any questions you have or see what we can do to help you out.
Yep, and likewise, my website, the easiest one is KarenRands.co, or you go to Cougarand.com, Kugarand, and pick up the free ebook, 12 Secrets to Innovation and Wealth. It's just highlights of the to me the most obvious things. There's 12 out of you, so if you're watching my book, 12 out of that I think are really important. And we can always, right there is a way you sign up for that. You'll get a link to my calendar, and we can set up a time to talk about what you're doing on the private side and what you got to do from a messaging and strategy to reach investors. And with that, onwards and upwards, all you capital fans.
Speaking of upwards, Karen's URL is right above her head right now. So
There you
all
go.
you have to do is look up to find it.
That's my subliminal advertising.
Yeah, I think it works well. All right, so we'll see everybody next week.
Yeah, and I've got in 20 minutes, I've got a next live stream with John Gossier. He's going to be talking about his big 9-figure exit and how he built one ad tech company to a 9-figure exit while he's building the company that he's still running and a fintech model for Film Hedge. So tune in for that. That's going to be a great conversation. We're going to recap our call from 23 and find out all the great stuff he's doing and how in the world did he make that happen. So.
Nine figure, that's a minimum of $100 million. So that is going to be a fascinating interview, and everybody should turn in and check it out.
Yeah, and given the press releases I saw it and how happy he and his co-founders looked, I think it was a lot more than $100 million.
I hope so. All righty, that's it. We're out of here, and we'll see you next week.
Okay, bye-bye.